Welcome to part 5 of the Trading Masterclass. In this video, I will be explaining indicators, tools, and certain terms that are used within the trading world. So, I think the best place to start off will be the indicators and tools. And I'll just highlight some of the ones that I particularly like to use, and I'll explain the reasons behind them all. And the terms, they'll come up as these indicators are shown, just to help them be understood a little bit better. Okay, so the first one that we're going to dive into are EMAs. Now, you've heard me say EMAs several times. What EMA stands for is exponential moving average. I hope by now in these videos you kind of caught on to that. I have mentioned it before. But just to give you a quick rundown on what they do and what they mean. Okay, so I prefer Fibonacci EMA ribbon and at the close, right? I use the close as my source. So you can use the open, the high, the low, high, low, 2, or whatever. Like you can pick whichever one you really want in there. Okay, I just like the close. It's a personal preference. Okay, so there's that. Style. The reason I really like this Fibonacci EMA, I don't have to input my random numbers. It has all of the Fibonacci numbers here. The only one that slightly bugs me is 610 should be 618, but I'll let that slide. You know, it's not going to be the end of the world, but yeah, it does bug me a little bit. That's okay. So, yeah, the particular ones I use is 5, 13, 55, 233, 610, and 987. Okay? For the only reason these are the ones that I prefer, and I found that work the most frequently for me. I'll show you if I pop, like 1, 2, and 3 is really pointless. It's just, it shows you the speed of the candle, right? But I'll show you what happens if I put all of these on. Okay? And show you the visibility of it all. So you see that it is a very large ribbon in this instance, okay? And I mean, you could see how valid some of these resistance and support zones are even off of the EMA, right? You could see them bouncing off the particular ribbon. You can use them all. I just prefer the 6 that I have set. Otherwise, you can tell that it's going to be a very messy chart to look at, right? Especially when you add other indicators and tools to it. So just that's my personal preference. All right. And yeah, the reason being is these are the smaller ones. So once these kind of indicate a trend, if they line up with the big one, that's how I personally enter trades. I will show you the strategy that I use later on in other videos. I guess I'm going to be doing it maybe in 2 or 3 videos from now. We'll see when we get there, but it will be titled, you know, the scholar strategy. So, yeah, that's just EMAs in a nutshell. What they do, so the 5, for example, what it does is it counts 1, 2, 3, 4, 5 previous candles in order for it to kind of show you where the current point is going to be. The red one, it takes the history of the previous 13 candles, hence the 13 on the EMA. This one is 55, so 55 previous candles to show you where its position is going to be. The white 233, 610, 987, etc. Right, you can set them up so they go all the way to like 4,000, I think it is. Yeah, 4,181. I mean, that's a little excessive. We don't need that much information. Okay. I mean, you could try it out. It might be pretty interesting to see how it goes and what you get to see that far down the line, how it replays 4,000 candles after it actually originated, right? But again, you can use other indicators that have EMAs. There's one that's, you know, an EMA cloud, so it just looks a little bit different. DeLorean EMAs, right? So there's several that you can pick from, but just to give an example, right? If I would click DeLorean EMAs, you see the lines behind mine, they're slightly different, right? And they go off the generic ones that every trader is used to. So that's 5, 13, 50, 200, and 800. Why are those numbers picked in this particular one? Couldn't tell you. I don't know what the significance is behind those numbers. I just know the traders like them because they're nice round numbers. Okay, as you can see, I prefer using mine because they're a little bit more accurate. They give slightly better information, but that's just a personal preference, right? You can use whatever you like. I just find this to be a tad more accurate than the DeLorean. So that's Fibonacci EMAs. The next one is TDI. So TDI is a very unique tool to have in your arsenal. Okay, I'll pop on DeLorean TDI to show you what that looks like. And it is this bottom graph. Okay, so I will extend these guys just so you can see this in larger detail. Okay, and we'll spread that apart just so the 80s and the 20s are visible. Okay, yeah, we'll just leave it like that. So within this TDI, it's called the Trader's Dynamic Index. Okay, so it has a few pieces of information on here. One of them is the liquid 50, which is this yellow line. So that means that over the signals, like the green and the red, it's very similar to the 5 and 13 EMA that you have on there, right? The green moves sharply and the red moves a little slower. So you can consider them signal lines. The blue, what that stands for is the volatile bands, right, or VB. And typically what people like to see with this is when VB expands, that's a good time to enter a trade. When it starts contracting and stays contracted, stay out of the trade. When green crosses red, that's a good time for an entry. Like, there's multiple ways that you can use this. I don't really find a use for it with the style that I have. You could definitely incorporate it, right? But for example, we're going to switch over to the 4-hour just to see better visuals here, okay? So as you can see with the TDI, right, when you have a big candle like this, you could see this green signal line really cross up high, all right? And then once it starts coming back down into the VB, there's one trading strategy that would be considered an exit, okay? It doesn't matter where the candles are. If it pulled back that far, you're out, okay? And then once it crosses the red, you're out. But if it's spread out like this, you know, and it matches the EMAs, it's a good idea to stay in the trade because until it actually crosses back over the red, it's not really going to be signaling to exit, okay? And that's, you know, you can maximize your pip gain from that. So for example, you can see right here on this candle on the TDI after it crosses. So if we would take a sell here and just watch it keep going, you would see right here on the pullback, a lot of people will get nervous and probably exit. But what does the TDI say? The bands are still completely split up, so trust in the analysis, right? Keeps going down, doesn't cross, right? Even when it's up here. But if it did cross, then you would exit, right? Gain 70 or 80 pips or something like that. But look, keeps going, keeps going, keeps going, crosses right here, right at the end of that candle, and then there's your exit, 142 pips. Right? Pretty decent. Many different strategies that you can apply. I would say that it is a very good idea to incorporate this as a new trader instead of the MACD, because this is going to give you more information than the MACD does for these particular instances. So now I'm going to jump into the MACD. And what we have is two things that you got to be cognizant of when using this particular indicator. Okay, these red valleys and blue peaks, that's the histogram. Okay, and the green and red line and the white line that I have are the signal lines. What they indicate is just the price movement where you see the candles, right? So it's kind of a mix between the price and the volume, so to speak, right? So it actually moves a little bit opposite of what you have here, and there's a very good reason for that. If you have the candles that are going up, it's kind of like a fake out, right? The MACD has more information in it than just the candles themselves do. So if this is going up and the candles are going up, everything's in alignment. If the candles are going up and your MACD signals are going down, something's a little bit fishy. You know, there's a very good chance that the trend is about to reverse. Okay, and When I see this going down and this either going sideways or up, I don't touch it, I stay out, right? The time that I want to jump in on any trades is when I see this split nicely, and you can see that the signal lines are parallel with each other and just dropping, and the histogram is starting to get a little bit bigger. Okay, once the histogram changes color and starts dropping the opposite way, for me that's an early signal that the trade has a potential exit coming up. Okay, now the best thing about the MACD when you align it with your candles is what's called divergence and convergence. Okay, divergence is when you have opposite directions moving with your candles compared to your histogram. So let's blow this up a little bit, okay, and give you an example. Just within this area itself, okay, so I'll bring that down. So what we have here is a bit of divergence, right? I like to measure divergence with a different color in between the two peaks that I'm looking at. There's some people that just go from peak to peak regardless of the color itself. I just find it to be a little bit more accurate when you have a valley in between your peaks or two peaks in between your valleys, right? That's just a preference of mine. So let's point some out, okay? In between, see, so I gotta go from here to here because those are my two peaks. There's a valley in between, and those are my rules, what I just mentioned, right? So between two peaks, here we go. This is the candle that it's drawn from, and this is the candle that it's drawn to. Okay? Does it show any divergence? No, it does not, because these lines are going in the same direction. This is what you would call convergence. Okay? Even though that they're spiked up, showing that there's buying interest here, there's two things that you need to consider. The first one is that it's forming lower peaks as it drops. And the big one, the signal line, is actually below where these peaks are. So even though that it was climbing, the signal line has been way, way down here. Okay? And you can see how far down it actually dropped. It was pretty deep. Okay? And it had a pull up, and that's where you got this peak because these ones were not very deep. Yada yada, right? It doesn't really matter what the major reason is. All you need to understand is that this is convergence. That means it's going to be aiming to go in the same direction. Sure enough, even though that it has a little bit of a peak going up here, you could see that it drops overall. Okay, now we're going to get rid of this one and we're going to try to find divergence. So for example, here, right, where's the next peak? Right here, right? So is that, or no, the next peak is actually right there, okay, because that's higher than this little guy, and there's a valley in between. And now on here, we have from there to there. So this is divergence. You can see the lines are going in two opposite directions. The candles are going up while the histogram is going down, okay? This divergence in particular is a bearish divergence, okay? The reason why it's bearish is because histogram is dropping, candles are going up, and this signals that the overall trend will start to drop sometime soon, right? Doesn't mean that it'll happen. It's just a good starting point to see, hey, you know what, maybe this is going to be over and we're going to see a drop soon. I mean, here it kind of consolidates for a few days, right? Like a couple of weeks, actually, May 23rd to June 9th. So that's 4 weeks almost of consolidations. 4 weeks? No, I can't do my math. 3 weeks, pardon me. Okay, consolidates and then finally drops. But you can see on the histogram here how sharp that was with the signal line. Okay, and the important thing is, as this was consolidating, you can see the signals dropping, right? So a lot of price interest is going to be coming down. Right? And then it started consolidating on the bottom here, even though that this was moving sideways. So it finally dropped, right? Good example to see if this is moving sideways, consolidating, and right here in the same zone, right? Here's what we got. Very big moves, okay? It goes to show that there's something coming. And sure enough, it was a little bit of a drop, okay? So 4 different types. This is a bearish divergence. We go from peak to peak right here. Okay. There is one that is where we're going to have to find one. Oh, here's a good one. So here to here, right? So both of these are bearish divergence. Okay, and you can see that even this is in the opposite direction, right? It's just this one is going this way, and this one is going this way, right? Overall, both of these patterns will be taking that way. Okay. Now, the only reason they're both going down is because they're both drawn from peaks to peaks. Okay. When you draw from the bottom and the bottom on the histogram, I'll give you an example right now. Okay. Let's pick this area. Okay. That's pretty clean. And I'll shrink this down a tad. When we go from a valley, right, we have a valley peak on this candle, and then the next valley is here. Doesn't mean anything. That's convergence, right? Because you can see the candles go up and the valley goes up, right? So that's not a good example to show, not for divergence anyway. Okay, so this valley is higher than this valley, so that's convergence because they both go in the same direction. Great. Let's see, this one. This is a good one, okay? So from here to here, right, where you see that go. And like I said, close. I didn't say it, but I'm going to say it now. It's close to close. Okay, so I'll just zoom in on this, where the candles close. So close on this green one right here, and that's where it peaked. Okay, and this is what we have on the histogram. It's going up. So this is bullish divergence. Why is it bullish? Because we found divergence from valley to valley, right? From valley to valley. This is going down, this is going up, that's bullish divergence. And sure enough, what's the move right after? Slight move upwards, right? You can see that these moves aren't huge by any means. All it does is just confirm the divergence itself. Now, it doesn't look very big, but that's still 144 pips. Like, that's pretty significant. Right? And as you can see, even though that is going up, it doesn't actually peak until the end of this candle, right? So even if you'd be taking that exact trade, let's say when you got the peak, there's no way of knowing it's going to go, so this would be the entry once you see the histogram drop down. Okay, so from here to here, that's really not much of a gain now, is it? 12 pips. That's why it's just good to know where the direction is going, but there's other indicators you want to incorporate. So that was the one. Okay, there's one more divergence to look for, and it is, we want to find the other one, right? We went, this was lower than this one, and this was higher than this one. So now we want to look for the opposite, lower and then higher, and then lower and higher here. Okay, so let's see where we can snag that. Nope, that's normal, not the hidden. Let's see. Nope. Oh, there we go. That's a good one. So from here on the candle, and where the next red peak is about there. Okay, so you can see that going. And right here we have it going to the opposite direction. Right, so you can see this one's climbing. And this one's dropping a little bit. I mean, it's going almost sideways, but it does have a clear direction moving down. Okay, another sign of bullish divergence. Right, that is what's important. So you have a valley right there, and you have a stronger valley on the histogram, but this is higher than this position. Therefore, bullish divergence. There is a very good chance this will start climbing. Now, this is the only crappy thing if you're only using MACD as your signal. Look at the signal line. It's pretty much going sideways, right? Whereas this is climbing ever so slightly, right? And just that climb, like if we go from bottom right here, where it started to drop, even if you entered there, you need a 100 pip stop loss, right? For a potential 200 pip gain. This is why, like I said before, MACD it should not be your only solution for indicators. It's useful to be able to identify convergence and divergence because it'll show you a potential play coming up. But you need more analysis in order to determine where that entry is going to be. So MACD, never use it by itself, okay? Next, we have volume profile. Right? This tool I actually showed in the last video. There's two ways to use it. Okay, you just need to identify these things first before you draw it out. Okay, so it's really between a trend and a consolidation. So we see right here, this is the last high and this is the lowest point. The trend is really the easiest to point out, right? You don't have to draw it from the top. Watch, I'll draw it even from here to here. It doesn't matter as long as we get the right area, and then you'll see your point of control. Crazy how we just talked about this in the previous video and how valid it is when we're just analyzing GBPUSD as it currently stands, right? August 31st is today's date. So there you go. Look how valid this is from the trend. This is exactly where it pulls up to. Very interesting, right? What do? We add a Fibonacci right on top of that, which again I explained in another video. You see the validity of volume profile is right on a Fibonacci line. The chances of it hitting and reversing are extremely high compared to, let's say, if the volume profile was somewhere in the middle or much lower, and these candles were climbing already. So look, this area hit, that would have been a perfect entry for a sell. Okay. Now, I kind of kick myself in the butt because I do more thorough analysis as I do these videos. Sometimes to go through every single pair that you see on the right-hand side here would take hours, right? I don't really have the time to spend 6 or 8 hours on these charts every week. I tried to blast through them to see the more obvious trades. Now this one, if I just would have been a little bit patient, this would have been an amazing trade to grab at the beginning of August, because as you can see, from here to here, where it's at right now, 693 pips. And that would have been an extremely tight entry. Would have been able to grab it somewhere off the volume profile. 60 pips would be a reasonable stop loss. And profit right now is looking at 11.5 to 1. That's a fantastic trade. Fantastic trade to be in. You see how important it is to analyze every week, right? I made the mistake of just assuming, okay, it's kind of consolidating and bounced off already, rejected, and I stopped paying attention, right? If I would have jumped in on this currency pair a little later on, this would have been much more obvious for me to be able to snag. But that's okay. This is a learning process for everybody. Even people that have been trading for 10 or 15 years are learning new things every once in a while also. All right, so fantastic tools to use at your disposal. There are a few more left that I want to get into, and one of them is in TradingView is paid for, unfortunately, right? So you'd have to subscribe to be able to get it, and it is, let me just see if it's right here, if I have it up. I do not, so let me find the indicator and show you. It would be under technicals, volume profile, session. Oh, I do have it favorited, so it is in here. Session volume profile. Okay, here we go. So this is a very useful tool. What it does is by session, it means the 24-hour trading day that it's open for. Okay, and the red lines show where there was a volume profile on that day and that it never closed. All right, that's it. It's just a very interesting tool to show you, hey, there was a gap formed here. Very likely it is to close. I would recommend that if you do use this, there's going to be a lot of back testing involved to see how valid it actually is. And by that, I mean taking a replay, hitting a random spot, okay? And you would be counting the gaps that it closes. All right, so every gap that stays open compared to every gap that closes, you would have a tally of for and against, right, to see, okay, how long does it take to actually close, and does it actually close, right? If you've ever watched my videos in the past, this is what I do for NASDAQ, but I draw them up manually, right? This isn't volume either. These are just gaps that are open and closed, and I have different colors to signify what they actually do. All right, but that's my personal thing there for GBPUSD. When you just use that indicator, that's all it's showing you. It's showing you when the gap has been opened and when it's actually closed from the point of control of the previous day. Okay, very interesting tool. I don't particularly use it, but some people could find it extremely helpful. The last one, or sorry, the second last one actually, Murray math lines. Now, a little bit interesting on this too. It kind of shows a range of, where it's potentially, you can read it, imminent bearish reversal, strong pivot, weak stop and reverse, ultimate support, oversold, extremely oversold, right? These are calculations that are plugged into the equation of this particular indicator, and all you have to do is pop it up, and then you see kind of a long-term projection, or depending on the time frame that you have, where it's potentially going in the next, several days, several weeks. Right? If you use the 1 hour, for example, it will give you a different projection to see where on the short term this would happen. 15-minute time frame, right? Same idea. You get a better view of where it's actually going. So you can see right here, extremely oversold. What's the first thing that it does? Whoop! Zip all the way back there in a 15-minute time frame. So watch this. How did that actually go? It bounced off here, and it climbed 53 pips, and then it dropped back down, right, into oversold territory. So the chances that it's going to keep dropping, I mean, GBP versus the USD, United States dollar has been extremely strong for the last, 5-6 months. So, I mean, it's not going to stop anytime soon, right? So here's the long-term time frame. It's been dropping hard since June of 2021, right? So that's over a year that this has been bearish, and it's been dropping harder and harder as time goes on. Right, this is a crazy drop in the last 5 days. Like, we went from $1.30 comparison, and now we're at $1.24. So it dropped 6 cents on the pound, right, within 5 days. That's pretty significant. So anyway, just gonna get rid of these lines right here. A lot of dots that I made for no apparent reason. We just like dots. Okay. So those are Murray math lines. Just gives you a general idea of where the potential target is. So you can see right now we're extremely oversold, and it's getting to a point where there's very likely going to be one of these happening, and then a potential continuation, right? So good example to draw. Right here from the peak to the oversold line, you could even project where it's going to hit off, right? And if it does that, you can see 618 reversal, potential is right here. All your lines have a potential just to bounce off and drop, right? The higher it goes, the more likely it is to reverse off this area, hence why it's called the golden zone. If it just bounces off this, that means the trend is incredibly strong and there's no end in sight. Just kidding. There is an end in sight, but at the same time, it's really hard to determine where that's going to be without any other indicators. Okay, so that is Murray math lines, just an interesting tool to kind of add to your arsenal. Okay, the one I have here is just sessions. All it does is break up the sessions themselves. So look at the settings, right? Asia, London, New York, right? There's technically four sessions. There's Australia, there's the Australian, the Tokyo, the London, and the New York, right? Those are the major markets that open for Forex. It just kind of combines Asia with Australia and Japan in this case, but Japan is the one that opens first, then Australia opens about 4 hours later, then London opens 5 hours after that, and then New York opens 7 hours after that? Yeah, 7, I believe. It's 1 a.m. my time. New York opens at 6 hours. 6 hours, pardon me. New York opens at 7 a.m. 7 and 6 a.m. my time, 8 a.m. Eastern, whatever, for banks or Forex, okay? So there's that, 8 a.m. or 9 a.m. God, I can't even remember anymore. But whatever, that's why the session breaks are extremely helpful. Use them, they're going to be great. Okay, on the daily time frame, you can't really tell. That's why they actually appear on the 1 hour, right? So there we go. You get the purple, which is the Asia, the green, which is London, and then There we go. So 6 a.m. it opens my time. Okay, that is the New York session. So there we are. Just a helpful little tool, right? Doesn't really do much. Just kind of gives you a visual of when markets open and close. Okay. And finally, the other indicator that is very helpful to a lot of traders, they're called pivot lines, okay, or pivot points. Not to say that they're going to be incredibly valid for you, but in one of my strategies, they're actually involved. Okay, the most generic one is this one right here. And I do have a how-to video as to how to set this up and to jump into a little bit more detail, so check it out. It's titled How to Trading View Pivot Points. It's pretty straightforward. It shows you how to set them up and what they all mean. Okay, but just to throw up the visibility here, this is what it does. Okay, it breaks apart the weekly session, I believe, into, you know, from R4 to S4. R4 is extremely overbought. S4 is extremely oversold. As you can see, once it breaks S4, it doesn't really have any other target below it. So this has just been crushed. Okay, but it kind of gives you an idea as to where things are going to pivot. As you can see, even on the weekly, right? If we zoom in on this on the 4-hour, you can see how valid this is. Like each candle kind of plays around within the pivot. So look, you see it wicks, closes in the middle, wicks off this, wicks off that, closes underneath, wicks off again, closes right on the pivot, closes right on the pivot, just below, wicks off the pivot, closes below, and then drops a little bit more, jumps up, and just where that pivot line is. So again, not to say you're going to be able to predict the moves. It's just you might use this to help predict entries and exits. And this is going to be more helpful when you scalp, you know, do short-term day trades. Very useful on the NASDAQ and Dow Jones, I believe. Like there's indices that you can trade. For Forex itself, I would say it's better to use it on swings that last a few days, right? And again, it's one of the things that are helpful, but it shouldn't be the only tool you use, right? Watch this. Here's a little peak on the short term. Here's the valley. We draw it across. You see, where does it line up? Here's a pivot point. Here's the Fibonacci. You know, we're in the golden zone for reversal in this area. And look, we have 1, 2, 3 pivot points that it could hit off of. The 618 has the R2. Look at that. What a beautiful reversal. Down it goes, right? So lots of ways that you can add to it. But as you've noticed, with every indicator, I use a Fibonacci. It's just, it's kind of my standard, right? I really enjoy the Fibonacci. It is extremely helpful. It helps confirm my analysis with the other types of indicators or tools that I use. Okay, so that's pivot points in a nutshell. Hope that this video has been helpful. There are a few other things that we can dive on as far as terms, but they'll come up as other videos are released. Okay, the only one that I didn't talk about is ADR, or average daily range. You know, it's useful, I guess, if you're just day trading, but for me, there's really no reason, or there's no strategy I imply. Geez, why is my vocabulary so difficult tonight? Pardon that verbal regurgitation. The ADR is just not a tool that I use in my arsenal. Okay, I don't find a need for it. Right? There's many other types of analysis that you can have. It just kind of pulls up from the first half of the day, how far it's moved up and down, and then you either divide by 3 or multiply by 3, and you get your general range. Right? There is one here. If I remember the name, I think it's this one right here. Market Maker by Juicyman. Kind of a silly dude's name, but that's okay. You know. So we go into settings, so I guess it appears as mytradingjournal.com. Style, you know, you can set up whatever you want in here. I don't really understand it because I haven't been using it, right? But then you can go ADR, see, show ADR boxes, show average daily range label. We don't want weekday, we don't want Asian range, we just want this, okay? So here you go. As an example, we jump over to the 1 hour. And what this is going to signal is the potential range that it's going to move in on the day. So you see it opened, it was kind of in the center right here, it dropped way below, popped open, you can see it's in the middle of this range, so this is an indicator that kind of does the work for you. See, another idea pops right in the center of where the range appears, and then you have your movements in between where it's a potential high and the potential low for the day. And that's kind of it, right? That's the information that it gives. Again, in the middle, it pops when these are coming out. Didn't really go up that high. It dropped much lower. Whatever. There's much better indicators than this to use. So, whatever your personal preferences are, just in case you're wondering, this Heikinashi, and it's just, you can change your candles to Heikinashi, but this indicator kind of adds it to your candles, right? So in order to change that, it's right here, right? You can see Heikinashi. My candles will change into that replay bar. Why do I have that even open? I'm not using it. Where did you go? See, this is kind of a pain in the butt now. I got to find my price range. There we go. Okay? So if I hide this one, this is what Heikinashi looks like. Right? It's a little bit more defined. You got red, even though it's all going down. There's green candles in here, but Heikinashi just continues on with the trend. The longer and deeper the Heikinashi color, the more likely it is to continue the next bar. Right? As you can see, if it forms a doji, it's kind of up in the air what the next play will be. Right? But as soon as it spikes like this, see doji, look at this, is just gigantic. Right? Next play after that, very likely it's going to keep moving down. Right? Dojis, who knows what's going to happen next, right? And it consolidates. Some people prefer using it, right? I haven't gotten used to it. I prefer candles. I find there's more information in them, right? Because it shows me where the wicks are, where price went the entire candle, and where it actually opened and closed. Right? I know Heikinashi can do the same thing, right? But watch. This one right here, I'll just drop a little box, right? This candle, big doji, right? Let's see what it looks like as a candle itself. Not at all the same thing, right? So better price information with this guy. That's all, right? You can use whatever you like. Line graphs, I find, are the least informative, right? So, I mean, use them if you want, but you're not going to get a whole lot of information. I think candles are the way to go. That's just my personal preference. Okay, so everybody, I hope this video has been helpful to you to understand some of the terms used, and stay tuned for the next video. That's the one where I'm going to dive into how to actually enter a trade using market structure. Okay, so you don't want to miss that one. It's going to be a little bit, actually very crucial, because this is going to allow you to understand where to formulate your trades, how to set your stop losses, and what to look for your potential exits. Okay? So stay tuned, and the video after that, I'm going to dive into my strategy. So hope you like it, folks. See you next time.